Tesla has had a great year on the stock market. Shares are up 133% so far this year, but I think there are a number of reasons not to buy the stock right now. Despite the fact that the stock price is up, operations are actually getting quite a bit worse, and I think there are a few bad things coming on the horizon, a lot of growth expectations that may not be met by the company. So I'm going to go through those today. Even if you're bullish on Tesla, it is worth understanding what the bear thesis is for the stock. I don't have a position in Tesla, but this is absolutely not a stock I'm buying right now, and this is why. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And the first reason not to buy Tesla is the company simply has a supply and demand problem. This is fundamentally a manufacturing company. And that means that it can have a certain amount of supply of vehicles. That's its manufacturing capacities. Tesla has been growing that tremendously quickly over the last decade, and that's driven a lot of the company's growth. But as that supply has grown, we have not seen demand grow at the same pace. How do we know that? Well, we know that because Tesla has been reducing prices. During the pandemic, when the supply of vehicles overall was down, Tesla was one of the companies that was able to continue increasing production. And what did it do at that time? It increased prices. So that shows us that just a few years ago, the company was increasing prices because supply was not as high as demand. There was a mismatch. Now that has shifted the other direction, and Tesla has had to reduce prices to move the vehicles that it has through the system. Despite the fact that it's reduced prices and reduced margins, we've seen inventory rises. And I'll go to one chart which I think shows exactly what's happening here. This is a look at auto gross profit on a trailing 12-month basis. So not just a quarterly basis, but a trailing 12-month basis. And you can see that gross profit peaked in December 2022 at $20.4 billion. That has fallen nearly $3 billion, or about 15%, to $17.5 billion in the third quarter of 2023. Over that period of time, the sales of vehicles on a trailing basis has increased from 1.3 billion to 1.7 billion. The numbers are even more stark on a quarterly basis. In the fourth quarter of 2022, Tesla made a gross profit of $13,625 based on these numbers right here. And these include the credits that Tesla gets, those clean energy credits that it gets from other companies. So $13,600 in the most recent quarter, that profit per vehicle dropped to just $8,431. Just a massive decline in the amount of profit that Tesla is making per vehicle. On top of that, we have a number of headwinds coming in 2024. The company's not going to qualify for the full $7,500 tax credit for some of its vehicles in the US. That will mean that they might have to reduce prices further on those vehicles and take away almost all of the margin that they're making. But this is really the catch-22 that Tesla has gotten itself into. The company is increasing production, recently got approved to build out the Mexico plant, which is expected to be another low-cost vehicle, so pushing down those prices even further. So they're increasing that supply, but prices have to come down, which tells us, based on supply and demand 101, that there is not enough demand for each of the vehicles the company is making. So this is just a trend that is not moving in the right direction. And by the way, other automakers are not feeling the same pain. The margins at General Motors and Ford and Stellantis have not dropped at all in the same way that they've dropped at Tesla. So this is a Tesla-specific phenomenon. This is actually an EV phenomenon because a lot of the other EV automakers are starting to feel price pressure as supply of other vehicles comes back online. So this is a massive reason not to buy Tesla. The auto business just is not going to be as profitable as I think a lot of people thought it was going to be as recently as just a couple of years ago, but the stock price has not reflected that. The second reason not to buy Tesla is related to FSD, and I'll get to that in just a second. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Full self-driving and robotaxis were supposed to be this massive business for Tesla, and really we're supposed to be rolling out by now. Elon Musk has been talking about how Teslas would be able to drive themselves going back to at least 2016. But that has not been the case, and the company even rewrote all of their self-driving software just this year. So as we've seen companies like Waymo, Cruise, and Zoox begin to expand their operations across the country and across the world with what's known as level 4 autonomous driving, Tesla can't get out of level 2 autonomous driving. And we have seen that recently with the company's statements, both in court and then to investors, is that this is absolutely a level 2 autonomy product. And the problem is Tesla is likely years away, at least, from getting to level 4 or level 5. And the reason for that is you have to test those systems. You have to test whether or not a fully autonomous system is going to be safe enough for public roads, especially in California. California really drives the regulatory environment here in the US. And Elon Musk has said on recent conference calls that the rules are the most relaxed in the US. So that's why they can actually offer FSD and autopilot. They can't necessarily do that around the world because they don't have regulatory approval and they don't even need it in the US. But this is also the reason that Tesla has not taken on that liability themselves. As soon as Tesla moves from level 2 to level 3, they take on the liability if there is a crash. Every time there is a crash or an incident, Tesla can fall back on the fact that drivers take responsibility even if FSD is operational. So if there's an accident, it's the driver's fault. Once you go to level 3 or level 4, it's no longer the driver's fault. It's now Tesla's fault. And until we see Tesla move to the point where they're willing to take that liability, I don't think this is a product that investors can count on. It appears that the adoption of FSD is going down. They have actually reduced prices recently. The robo-taxi, which was supposed to be a reason to buy a Model 3 vehicle, is nowhere to be seen. And so I think putting any value on autonomy and Tesla's version of autonomy is not a good bet right now. There are other leaders in the industry who actually have vehicles on the road, who are driving themselves, who have regulatory approval. And those are the businesses that I would invest in today, not in Tesla's FSD, which has been nothing more than promises for over 7 years now. The final reason not to buy Tesla stock is that shares are trading as if a lot of these products that don't yet exist have real value. So investors are paying for future products to add value, even though they may never actually do that. And I'm going to start with a couple of valuation metrics to show just what a premium Tesla is trading for. The first one is Tesla's price to earnings multiple compared to Ford and General Motors. And you can see here that Tesla trades for more than 10 times the price to earnings multiple of Ford and General Motors. Right now, Ford's price to earnings multiple is 7.3 and GM's is 4.8. Tesla is trading for 81 times earnings as I'm recording today. So just an astronomical multiple. And remember, Tesla's earnings are going down. So earnings are falling, gross margins are falling, and yet investors are paying a premium for this business. If you would rather look at a price to sales multiple, which may be a little bit more applicable in this case because margins can fluctuate all the time, you can see that Tesla's price to sales multiple is now 8.3. That same multiple for Ford and General Motors is 0.3. So the price to sales multiple is more than 20x for Tesla. Now, this is because the company is growing more quickly, so some premium is absolutely deserved. But I think these are just astronomical multiples. And the reason that I think these multiples are way too high is think about all the products that Tesla has priced in and that a lot of analysts, like the ARC companies, have talked about adding value that don't even exist yet. Tesla's robots, Dojo, the energy business is a commodity business that, yes, it's growing, yes, it's slightly profitable, but this is never going to be a 25-30% gross margin business. The solar business is actually smaller today than it was when Tesla acquired Solar City. So that business has basically been destroyed under Tesla. So investors are paying for these businesses despite the fact that they're not adding any value today. Meanwhile, the core business, Tesla's automotive business, is in a state of decline. So all of these, I think, are really good reasons not to buy Tesla stock today. Shorting the stock has proven to be a bad idea for investors for a very long time. And maybe eventually that will be a good strategy, but we have no idea when that's going to happen. So I'm just going to stay out of Tesla stock because I don't think the company, as a manufacturing company, and that's what Tesla is going to live up to these really high expectations. The auto industry just doesn't have a history of adding a lot of excess value. at very high margins. And Tesla is proving that in time, this is not a high margin business. So what do you think about Tesla's position today? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.